Ladies and gentlemen, good afternoon. Welcome to Keystar Corporation 2021 second quarter results conference. The meeting will be chaired by Peter Chen, our chairman, and co-chaired by Jasmine Hong, our CFO. They are joined by 5 executives, including GM of Information Technology Business Group and Commercial and Industrial Business Group, Joe Huang. GM of Medical Devices Business Group, Harry Yang. GM of Business Solutions Group, Michael Lee. GM of Networking and Communication Business Group, April Huang. And Chief Investment Officer, Michael Wang. This meeting will take about an hour. The agenda is as follows. First of all, CFO Jasmine will go over our second quarter financial results and business highlights. Peter Chen, our chairman, will then share with you our business updates and outlook. Our general managers of business groups will then provide overviews of their respective business group. Afterwards, we will proceed with questions and answers. You may submit your questions online. We will compile the questions and answer them during the Q&A session. Now, before we start, please let me first remind you that all forward-looking statements contain risks and uncertainties. Please spend some time to read the safe harbor notice on slide number 4. Thank you. Now we will proceed with the presentation. I'll turn over to Jasmine, CFO. Ladies and gentlemen, good afternoon. This is Jasmine. Before I go into the financial results of Q2, I would like to spend some time to talk to you about Keystar Group. Keystar is a global technology group with businesses spanning from information and communications, medical smart business solutions, and 5G networking communication. We were established 37 years ago in 1984. We are a Taiwan-listed company with a ticker symbol of 2352. And we have a capital size of 19.7 billion. We have consolidated companies in the tune of 183 companies, of which 14 of them are listed firms in Taiwan. Currently, our employee size is about 33,000. We have manufacturing sites in Taiwan, China, and Vietnam, and sales office in 197 locations worldwide. We have R&D sites in Taiwan and China. For revenue breakdown by geography in 2020, Asia accounted for 46%, Americas, Europe, others accounted for 29%, 22%, 3% respectively. The breakdown in the first half of this year is also similar. Our 2021 first half revenue was 106.9 billion, up by 29% YOY. We are committed to improving employee well-being and having named as a best company to work for in Asia for 2 years in a row. Also, we are sustainability conscious, having earned the Taiwan Corporate Sustainability Awards. And as for our business group, we have existing business, ICT, and high-value added business, including medical, BSG, and CG. Under ICT, we have displays, gaming, high-end general displays, and projectors, as well as IA solution products, automobile infotainment, TV, and digital signage displays. Under medical, we have 2 hospitals in China, including the one in Nanjing and the other in Suzhou, established 12 and 8 years ago, respectively. We also have equipment and consumables, including operating table, surgical light, ultrasound, intraoral scanner, and dentistry consumables, as well as dialysis equipment and related consumables. Under Business Solutions Group, BSG, we have 6 verticals, including hospital, factory, retail, energy, enterprise, and campus, offering end-to-end software and hardware integrated smart solutions. Last year, in August, we launched the NCG Group, expanding our business to 5G, fiber optics, AI, edge computing technologies. As for others, we have polarizers, optical film business. In Taiwan, our major investees are AUO and Darphone, both of which are listed firms. In Q2, our high value added business accounted for 32% of our total revenue. Now, for our Q2 highlights, we posted the highest Q2 revenue, OP income, and net income attributable to Keystar in 10 years. Our EPS reached 1.93 NT dollars, the highest in 10 years. For the first half, EPS was 3.01 NT dollars, a new high in 10 years, and was already higher than any other full-year EPS in the past 10 years. Q2 revenue and profit increased significantly. Revenue increased by 28%, OP income by 33%, net income attributable to Keystar by 301%. Profit growth outpaced revenue growth. Revenue growth remained in the double-digit range. Starting from Q3 2020, we've had more than 20% YOY growth in revenue for 3 consecutive quarters, and quarterly revenue of higher than 50 billion for 4 straight quarters. Q2's revenue exceeded 50 billion NT dollars. This is thanks to Keystar's strategic investment in high value-added business and increased demand in commercial industrial applications for our ICT products. Our high value-added business revenue increased significantly by 94% YOY and accounted for more than 30% for 4 quarters in a row. The revenue for our medical business also went up by 42%. Besides, our non-op income continued to make positive contribution. As we said last quarter, we've made changes to the accounting treatment of AUO shareholding from the equity method to fair value through other comprehensive income or FVOCI. Due to this, we had a non-op gain of 2.4 billion in Q2. For the first half, our revenue, OP income, and net income attributable to the parent of the company were also the highest half-year results in 10 years. We've registered growth in gross margin, OP income margin, and net income margin as well. Now, for our comprehensive income quarterly, net sales came in for Q2 at 55.9 billion, up by 12.3 billion or 28% YOY from 43.6 billion. All business groups posted growth. ICT grew by 9%, high value added by 94%, mainly thanks to the inception of NCG business in August 2020 and the sharp growth in medical BG. Gross margin was 14.8%, up by 1.2 percentage points YOY. OP income was 1.9 billion, up by 472 million or 33% YOY from 1.4 billion. Net non-op income was 3.3 billion, up by 2.9 billion YOY, mainly due to the change in the treatment of AUO shareholding and other non-op items. Pre-tax profit was 5.2 billion, up by 3.4 billion YOY. Net income attributable to Keystar was 3.8 billion, up by 2.8 billion or 301% YOY. EPS was 1.9 NT dollars, up by 1.45 NT dollars from 0.48 NTD. Our revenue, income, and net income attributable to Keystar all grew QOQ. Revenue went up by 10%, gross margin went up by 10%, and OP income margin was up by 11%. Net income attributable to Keystar was up by 80%. EPS was up by 0.86 NT dollars. So Q2 performance was stronger both QOQ and YOY. First half income, net sales came in at 106.8 billion, up by 24 billion or 29% YOY. ICT went up by 10%, high value-added business by 93%, again thanks to NCG and medical business growth. Gross margin was 14.7%, up by 1.2 percentage points YOY from 13.5%. OP income was 3.6 billion, up by 1.1 billion or 47% YOY. OP income margin was up by 0.4 percentage point. Net non-op income was 4.8 billion, driven by non-op items and AU-related one-time valuation gain. With the OP and non-op improvements, net income attributable to Kista was 5.9 billion. EPS was 3.01 NT dollars, up by 2.41 NTD YOY from 0.6 NTD. Balance sheet. Total assets were 182.9 billion. These items stayed flattish QOQ. Inventory was 42 billion, up by 6.1 billion QOQ, due to our strategic stock building and component purchasing activities in response to components shortage. Long-term investments were 3.2 billion, down by 13.4 billion QOQ, and FVOCI income non-current also increased by 14.8 billion QOQ. These two items reflect the changes to the accounting treatment of AEO shareholding. Total debt ratio was 66%, flattish QOQ. Key financial ratios. With the increase in inventory value, inventory turnover went up by 2 days QOQ. Cash conversion cycle increased by 1 day QOQ. Both of these are within the controllable range. Annualized ROE was 23.3%. Financial debt ratio 28%. Next slide. From Q2 2018 to Q2 this year, Kista's revenue and OP income have been on an upward trend, reaching new highs. In Q2, our revenue was 56 billion. We've been on an upward trend. It is up by 12.3 billion or 28% YOY. As for OP income, we have gone from 1.3 billion to 1.7 billion last year to 1.9 billion in Q2 this year, up 33% YOY. For the first half, our revenue was 106.9 billion. Income also achieved a very high level at 3.6 billion NT dollars. Next slide, EPS. For 2 quarters in a row this year, we posted more than 1 NT dollar for EPS, from 1.07 in Q1 and 1.93 NTD in Q2. Now let's look at yearly numbers. The 2017 EPS of 2.69 NT dollars was a near 10-year high. But at 3.01 NT dollars, the first half 2021 EPS was already higher than the 2017 record. Revenue breakdown by business. In the second half, ICT accounted for 60% of our revenue, medical 7%, BSG 12%, NCG 13%. These 3 segments, medical, BSG, and NCG, together accounted for 32% of our revenue in Q2. So based on this chart, you can see that our high value added business have been more than 30% for 4 quarters in a row. Next slide, high value added business yearly number. The high value added business revenue share went from 13% in 2018, 16% in 2019, 28% in 2020, and 33% in the second quarter. Well on the way to account for more than half of our total revenue in 2022. Next, we will hand over to Peter, our chairman, for business updates and outlook. Dear investors, friends from the media, good afternoon. Time really flies. Last time when we had the investor conference, it was in middle of May, on May 12th or 11th. Just a couple of days after that conference, Taipei and New Taipei City implemented third-level COVID alert, followed very soon by all the other cities in Taiwan. Over the past 2 to 3 months, I think we all went through very different times. Although the pandemic started last year, but the impact was less felt in Taiwan, despite the market and industry feeling the pinch to some degrees. COVID has put the resiliency and competitiveness of firms to stringent tests. Remote working was mostly carried out in branch offices of multinationals. So is the case with Kista. After the COVID third alert, we must accelerate digital transformation, be more adaptive to COVID risks, and also the changes to our work and lives caused by the pandemic. A lot of things have happened. And in Taiwan, also at Kista, we were very busy working out many issues, but Kista's steps never faltered. Last time we said we were optimistic about our first half results. Relatively more optimistic about the first half. Despite COVID, with half or more than half of the second quarter was under increased COVID alert, we deliver strong results for the second quarter. As Jasmine just told you, first half revenue achieved 106.88 billion, which was a very auspicious number in the Chinese culture. We didn't do that on purpose, but we achieved that very good result. Our revenue also increased by 24 billion for the first half YOY. For July, we had yet another growth of nearly 30%. The fast growth in revenue continued. It can be mostly attributable to our NCG business, which started last year. But one thing to note, because we started to recognize NCG assets from August last year, don't be shocked if you don't see our revenue increasing by 80% from August this year. The sharp growth was partly because we didn't have a base period for NCG during January to July 2020. So this recognition of assets from NCG contributed to the fast growth of our revenue, but we have other business also growing rapidly because we have a very clear vision. We want to bring the value-added business to account for more than half of our revenue. For the past several quarters, we've delivered strong results. As we just shared with you, we've been above 33 or 34%. Our hope is that we can deliver sequential growth quarter after quarter. Because of this long-term roadmap and vision, we will not stop. An old saying goes, it is important for you to envision the world the day after tomorrow. When you are able to do that, you can project what will happen tomorrow. How do you achieve that? As I said constantly, we need to have a clear and defined vision. Because we know what would happen in the next 5 or 10 years, we will follow through our strategy. And for the past 7 to 8 years, we have been doing this. We have been implementing our vision and keep pushing ahead. We hope that the half value added business will together account for more than half our revenue next year. If we do it ahead of time, we may be able to come very close or even achieve the goal in Q4 this year. But at least we will achieve that next year. If we are able to do that, then our next goal is to bring them to account for more than half our profit. We want to build a solid base to have more than half of the revenue from high value added business, consisting of the medical, BSG, and NCG. These 3 BGs have been growing really fast. With our direction in place, with our strategy in place, we have a clear vision of where Keystar will be in the next few years. We will achieve the revenue share of high value added business being more than half our revenue, the goal first, then we will strive for bringing them to more than half of our profit. When they are more than half of our profit, then Keystar will be a totally different company. Meanwhile, we are committed, as always, to leveraging the strengths of our grand fleet of strategic partners. We will continue to leverage the top performers and the unsung champions in Taiwan and in other parts of the world to form a more powerful fleet of investees to engage in global competition. Because of this vision, our revenue and profit, especially profit, improved in the second quarter. By accounting for the investment in AUO using FVOCI method, we have gained a one-time valuation gain. But as Jasmine told you, our OP income and gross margin both improved. So our OP performance was very, very stellar. And that is the goal we've been working on diligently. We are very fortunate that we deliver strong results. Of course, we have the contribution from accounting for AUO's shareholding using the FVOCI method, but it's still within a reasonable range. AUO has announced that its first half profit was more than 30 billion NT dollars. For the full year, it's going to be quite high as well. Many of you are experienced investors. I think you can do your own estimates. If you times that by 7% through the FVOCI method, we will come up with an amount that's basically equivalent to the would-be investment gain that we could be recognizing under the equity method. So the rest of the growth and most of the growth will still come from our own operating performance. With both improvements in our operating performance and non-op income, we expect that we have achieved the best performance in the past 10 years. We actually have already made that in the first half. So once again, I would like to thank you all for your long-term support. With our defined strategy, what's coming up next is that we will work harder on improving our profitability. because the panel industry is highly volatile. In the past, our financial results were highly susceptible to the ups and downs in the panel industry. By changing the recognition method to FVOCI for AUO's shareholding, we will be able to better demonstrate the results, our own operating results, as a result of our value transformation initiatives. And we also hope that by doing so, we will continue to have your support. And Keystar will continue to push ahead. I know many of you are interested in knowing about our third quarter outlook. As I said last quarter, I would be quite positive about the first half, and indeed we deliver good results for the second quarter. As for the second half, my view remains the same. Q3 is usually a higher season for the ICT industry. Depending on different sectors, the revenue contribution ratio between the first half and second half could range from 45 versus 55 to 48 versus 52. Usually, the second half is the seasonally stronger period. Especially for manufacturers, Q3 is the peak season. Today, despite higher visibility, we also have more concerns and risks because of the severe supply tightness of components and price hikes among raw materials. There are many factors driving up costs, including shipping cost. Currently, we're in the typhoon season. At the end of last month, a typhoon landed in Shanghai. So the container port in Shanghai was closed for several days because of the typhoon, wreaking havoc in terms of shipments. Given the uncertainties, we cannot afford to be too optimistic. So we have to be very prudent. And while we're being cautiously optimistic, I think it's important to be cautious because you need to take into consideration the demand side. Rising product costs and prices will ultimately affect consumers. Consumer can choose whether to buy or not. When they have to pay more to buy the same product, they may defer their demand. The industry is experiencing higher than normal inventories amid shortages in components. So it is very important for any company to be cautious in navigating through the risks. But for Keystar, we have been aware of these issues very early. We have been implementing proactive action. What's most important is to continue to improve the profit of Keystar, and will be more focused going forward. In the past, we have done several M&As to expand our grant fleet. And we have increased the holdings of the strategic partners under the fleet to reasonable levels. For example, we just completed the acquisition of Ace Pillar. Ace Pillar is an invested company by DFI. Ace Pillar is an OT-focused company providing channels for advanced products such as linear guideways and other advanced mechanics. It is behind the transformation and automation initiatives of many companies in the industry. We just brought Ace Pillar into our group for less than 2 years, and great achievements have been made. They have been able to deliver growth in both revenue and profit. We increased the shareholding in Ace Pillar from 35% to nearly 50%, so that we will be able to reward our shareholders, and also through increasing the shareholding and maximizing the gross margin and revenues, we will be able to contribute more to DFI and Kista to make more visible contribution to the profits. We will push ahead with our Grand Fleet strategy. We keep scouting unsung champions in the industry. For the future, we hope that we can continue to bring on more strategic partners. And through various efforts, we can deliver sequential growth in profits and also demonstrate our value transformation results. Ultimately, our goal is to demonstrate our results in revenues and also in stronger profits through the strategic implementation. I would also like to express my hope for you to continue to lend us support. For Kista, we not only focus on improving our own values, but also through the Grand Fleet, we hope that we can drive value transformation for Taiwan. This is something that I'm really driven to do, and we look forward to seeing the pace picking up. While we are working on transformation, I do hope that we can have more recognition from you and support from you. In the past, we have been recognized as a concept stop in the panel industry or in the display industry, but we are no longer that. More and more of our revenue base is coming from the medical, the BSG, and NCG business. These three industry sectors are very likely to become the guardians of Taiwan that safeguard our economic vitality. We hope that we can continue to strengthen our footprint in these markets and also to drive Taiwan's growth in these sectors so as to improve the overall competitiveness of Taiwan's industries. Thank you. Now, I would like to have the executives of our BGs to also say a few words. Thank you. Next, we will have Zhou Huang, GM of Information Technology Business Group and Commercial Industrial Business Group, to say a few words. Good afternoon. This is Zhou Huang, head of the ICT business. In Q2, IT and display demand was very strong, and demand was above supply. Due to semiconductor panel supply and shipping capacity shortages, our shipments were capped in the quarter. Unit shipments slid slightly. YOY. However, our revenue increased by 9% YOY, mainly thanks to our focus on high-end and large-size products for boosting our revenue and profits. As for Q3, demand is still very strong on the back of the higher seasonality. As I said last quarter, commercial activities will recover and strengthen. From June to now, commercial product shipments grow significantly, and demand continues to be quite strong. However, the shipments of consumer products weakened. especially high-end gaming displays and specialty products. Currently, displays and semiconductor products are still in short, and cargo shipping capacity remains tight. For Q3, unit shipment could be flat or slightly higher YOY, but revenue will be higher YOY. We will be utilizing the limited resources in our priority focuses. For Q3, we will remain our projection. We think that the demand will be stronger than supply. With the shortages in semiconductors and panels, we are still quite optimistic about our shipment outlook. Now we would like to hand over to Harry Yang, GM of our Medical Devices Business Group. Ladies and gentlemen, good afternoon. This is Harry Yang, GM of the Medical Devices Business Group. I would like to take this opportunity to share with you our Q2 results and Q3 outlook. Overall, our performance grew significantly in Q2, mainly thanks to the performance of our hospital business, and more importantly, the sharp increase in the demand for our anti-COVID products, especially face masks and ethanol solutions. Demand was immediately 4 or 5 times above our production capacity on the next day of the start of the third level COVID alert. We worked overtime day in and day out and still came below the demand. Because we focused on providing products to hospitals and clinics, our ethanol solutions were rarely available in the marketplace. We've been working overtime since May, and we expect the demand continue to be strong amid COVID. This growth is mainly attributable to the demand for anti-COVID products. As for Q3, as the economy gradually reopens, people are wondering if the demand for anti-COVID products would drop. Not exactly because the demand for ethanol solutions is becoming bigger with the reopening of restaurants and students coming back to school. So in the third quarter, we hope that we can increase our production capacity to leverage more automation mechanisms to meet the demand. With COVID cases increasing in Q2, some of our product lines were affected, such as hearing aids, because all the stores were closed. Also, the demand for medical consumables was also lower. As the economy reopens, we believe the demand for these product lines would also resume. So the demand for anti-COVID products is getting stronger, and we are expecting to see stronger demand for other businesses. We have a bright outlook for the third quarter. Moreover, we have a very good footprint in overseas for our dialysis equipment. Currently, we are working very well and with good progress made. We expect to see great contribution and growth momentum coming from dialysis products in the future. Next, we will have Michael Lee, GM of the Business Solutions Group, to say a few words. Ladies and gentlemen, good afternoon. This is Michael Lee from BSG. I would like to share with you the current developments in our group. BSG mainly focuses on helping customers pursue digital transformation. Under our group, we have listed firms such as DFI, Ace Pillar, SciSage, Awin, and Partner Technology. And also we have other unlisted entities under the umbrella. For our mid and long-term outlook, we will pursue helping customers doing a digital transformation, meeting the demands for cloud, mobility, digital transformation, and global expansion. The demands coming from these four aspects is very strong. We are mainly focusing on two major business lines at the moment for these four aspects. First is industrial computers. We provide advanced, future-proof industrial computers to aid digital transformation. Secondly, we have information services, providing automation and transformation solutions, mainly from SciSage and ACE Pillar. For the third quarter, we continued to see strong demand for digital transformation. During Q1 and Q2, because of the COVID impact, we were affected to some degrees, but the issues are being resolved. And we expect to see greater contribution from the third quarter. For mid and long term, we are still enjoying strong demand from the customers, and we will work our best to fulfill customers' needs with cloud solutions, and we will also work to address component shortage issues. Next, we will have April Huang, GM of the NCG, to say a few words. Ladies and gentlemen, good afternoon. This is April from NCG. NCG's business is headed by Alpha Networks and also consists of Hytron and IDT. In Q2, NCG's revenue was 7.56 billion, up 5% QOQ, and down 2% YOY. Even so, our first half revenue was 14.75 billion, up by 16% YOY. EPS improved from 0.15 to 0.42 NT dollars. So there was an improvement in profitability. For Q3, demand is still strong, but component shortages will be more severe in Q3 than the previous 2 quarters of the year. This is because while component supply became tight in the second half last year, we could still manage to secure components. So we increased component purchasing back then. However, from the February month of this year, up until now, we have been seeing worsening delivery delays and price hikes of components. Because of these shortages, we were negatively affected. NCG has to ship our products to many hubs. Our revenues won't be recorded before the shipments have been delivered there. Such is the case with Hytron. The revenue is only accounted for after products are shipped overseas. The component shortfall in the second quarter will carry into Q3. So for the moment, we see quite some impact on Q3's performance. We expect to see a slight YOY in Q3. Of course, we're working on securing the components. With some FOB in place, we will strive for revenue growth in Q3. Revenue in Q3 may come in flat QOQ. Because these are expected situation and risks, we have made some adjustments. We are using the components in making high-margin products and taking the opportunity to improve our fundamentals. For instance, Hytron in Q2 winded down production capacity in its Suzhou fab and ramped up production in its fab in Vietnam. These adjustments will help raise contribution to our Q3 profit. Despite the unfavorable forex situation and component price hikes, NCG's gross margin in Q3 was already higher than Q1 and is likely to see sequential growth in Q3. We have our eyes set on future growth. While the components are still in short, as Peter said, we are committed to pursuing profits. We are focusing on expanding our new business next year. When the component shortages ease, we hope to create more growth momentum and further profit growth rather. Despite component shortages, we've expanded our client base and secured new projects, which may kick off next year. So we expect to see bright growth prospects for next year. For the second half of this year, we aim to increase our revenue, secure components, and continue to improve our performance and profits. Thank you. Next, we will have our Q&A session. You may submit your questions online. In the interest of time, we will compile all the questions and answer them later. Hi, this is Jasmine speaking. We have received many questions, and we will have our executives to answer them. First, there are questions relating to our revenue. Given the cargo shipping delays, was the higher first half revenue was made because your clients procure the products ahead of time? What's your view on your Q3 growth prospects? Hi, Peter speaking here. I'll answer several questions here. There are actually many questions relating to the shipping issues. Cargo shipping has quite some disruptions recently besides the Shanghai port, which was closed due to a typhoon. Some ports in Europe and America also had blockages, and there's a shipping container shortage. All of these have affected our shipments. And also component shortages were very severe. What happens is that the company may have 500 or 600 components in place, but just miss one or two key ones. So the situation is very challenging now and can be fixed even if you want to. We won't know whether the key components will come in until the very last minute. So it's very difficult to plan ahead of time. And when the components finally come, it's all hands on deck. It's impossible that we could have done anything on purpose to inflate the first half revenues. We don't have a shortage of orders, but we are short of key components, causing us unable to make shipments. In June, our revenue registered a new quarterly high at 20.5 billion NT dollars, and we expect to record new highs in the second half. We will work our best to address the cargo shipping bottleneck. We will also work our hardest to secure the components and deliver products as soon as possible. Because the longer it is done, more uncertainties may emerge. As for the third quarter, as I mentioned earlier, Q3 is normally the peak season, especially for manufacturers. For brands, the peak usually comes in the fourth quarter instead of the Q3 because of the year-end shopping season and holiday season in the West. For manufacturers, the peak season is usually the third quarter. However, with the anticipated stronger seasonality, much is riding on component supplies at the moment. Firms with more bargaining power and making more efforts will stand at a better chance of getting the components. That's what we're working on diligently. Investors are also interested in knowing the changes in our high value added business. As your HVA high value added business revenue base dropped by 1 percentage point in Q2 from 34% to 33%. Does that mean they may not be able to grow to more than half in 2021? Actually, as I said, our vision set is to meet that goal by 2022. I was only saying that we may be able to reach the goal in 2021. So if we do achieve the goal in 2022, don't be surprised. But of course, it's better if we can do that ahead of time. Why did we have a drop by 1 percentage point? There were actually many reasons. First of all, because Q1 is the softer season for the medical business because there is the Chinese New Year holidays. Usually during Chinese New Year, people stay away from hospitals. Also, for the first half, as April from NCG has said, if you pay attention to Alpha Network's results, you would know that component shortages have become much more severe than Q4 last year. So because of medical and because of the impact of component shortages and also some component shortages with semiconductor products in the first half, we have been affected. Our projector line, which is our original business line, performed relatively better than last year due to the Euro Cup and Tokyo Olympics. So the drop by 1 percentage point in terms of the revenue base was actually the result of some ups and downs among the different business groups. I'll say that's a happy burden for Kisa. What's more important for us is to ensure that our revenue continue to grow. As we have told you, in the first half, we had a YOY growth of 24 billion and another 30% growth in July. And also, our profits are growing. Meanwhile, when there's any business opportunity, we'll do our best to capture it instead of seeing it passing by just for the sake of scaling up the high value added business. That's why I called it a happy burden. As long as we stay committed to this strategy, we are convinced that we will be able to reach the goal. There's also another question. Have your manufacturing sites in Vietnam been affected by COVID there? The pandemic has hit Vietnam hard, as many news reports have said. The virus outbreak actually started from Hanoi originally, which quickly contained the virus spread. but then it spread north to Bakjiang City in Hakbak. Keystar's manufacturing site is in Hatnan, which is about 60 kilometers south of Hanoi, so we are not affected. Hytron also has a site in Haiphong, which is about 100 kilometers away from Hanoi. So since we're in Hainan or Haiphong, we are not affected. Currently in Vietnam, Ho Chi Minh City has most COVID cases. The city is more than 1,000 kilometers away from Hanoi. There are many clusters of traditional industry sectors. For Keystar, we are not exactly affected. Here's another question. Has the pandemic situation affected BenQ Medical Center's business? Yes, of course. With surging cases, hospitals in China or in Taiwan have been affected. For example, hospitals in Taiwan were affected badly in the past several months. Dentistry, ENT, ophthalmology, which are most exposed to COVID risks, have been closed under the government's guidance. In some parts of China, recently in China, there was an outbreak in Nanjing Airport. And since then, the virus has spread to other cities, including Yangzhou and Huai'an. Originally, we had planned to resume normal operations at the hospitals in the end of July or August. But due to the surge in COVID cases, our hospital staff have been dispatched to support rapid screening and PCR testing. And the outpatient operations have also been suspended. But I believe the COVID spread will be quickly contained in Taiwan and China. So the impact on the hospitals in both sides, both places, will come under control very quickly. Here's another question. Are you planning to list BenQ Medical Center on the stock market? Yes, that's our plan. We plan to pursue listing. But in the past couple of years, with the pandemic and rising uncertainties in political and economic conditions, we decided to postpone the schedule. So we are postponing the schedule until the situation improves. But the listing goal remains unchanged. Which of your subsidiaries are involved in the development of your electrical vehicle business? A-Spiller is part of it. It is now a distributor of ABB's fast charging docks. These products are very high priced and high speed. And A-Spiller is a distributor. For electrical vehicles to be truly pervasive, there must be sound infrastructures. That is the charging stations. You need to have charging stations everywhere, especially on highways. When you're going more than 300 kilometers or even 400 kilometers per hour, you need to recharge your electrical vehicle. We've started out by building up channels, and A-Spiller has expanded its presence in the market. DFI is the parent company of A-Spiller. DFI offers high-end motherboards that go into charging docks. charging docks have very complex compositions, and the motherboards that go into them are highly value added and are very complex. Both of these firms have joined the MIH platform and are able to work alongside other electrical vehicle companies in Taiwan to capture business opportunity. As you know, BenQ Materials is also associated with the EV business because it has battery separator technology, which is used to separate the electrodes inside of battery, and it is able to enhance safety of batteries. So the material is also very different from voltage or current controls because it demands much higher level of stability. BenQ Materials has been able to garner the trust of many investors because it has made breakthrough in separator technology, which has been very, very well received by the market. So with regard to the electrical vehicle business, we have been aware of the business opportunity, and please be assured we will have a footprint in the market. For now, we are implementing channel first strategy. We are not following others' path. Instead, we are working at our own pace because we believe you need to have good channels, pervasive channels before you can make your electrical vehicles really popular and pervasive. So we will have a presence there. As for opportunities surrounding upstream components and modules, we will also do our best to capture the opportunity. And many of our companies under Keystar umbrella stand at the opportunity to capture those businesses. Thank you, Peter, for already compiling all the questions and addressing the questions that we have collected. Because we have scheduled an hour's time for the meeting, I wonder if there are any more questions from our investors. Okay, we have another one coming in. It's about gross margin. Keystar is improving our gross margin sequentially every quarter. Currently, our ICT business gross margin is at a double-digit range, and our high-value added business gross margin is above the consolidated gross margin. We believe that the margin share will continue to increase in the next few quarters. Thank you. We've now already answered all of the questions. Thank you all for participating in Keystar Corporation's second quarter 2021 investor conference. We will upload the audios file into the online platform. You may disconnect now. Thank you.